In this video, we're going to be talking about whether we are close to the peak of the property market or whether that is still really far away and what you should be doing about that. Okay, so if you're wanting to invest in the property market or you already have property and you want to know whether we're close to the top or whether that's still a fair while away, then in this video, I'm going to be talking about 5 data points that you can help assess for yourself whether we're close to the peak or not. All right, so my name's PK and I help people build passive income by buying properties that have positive cash flow and growth without a buyer's agent, without flying around the country doing inspections, using data. If you're watching in my Facebook community, thank you. For those of you who aren't there, 7,000 clients and investors. I'll leave the link below. You can join that Facebook community. And if you're watching on YouTube, thank you so much. Hit the subscribe button, turn the notification bell on, hit thumbs up. Thank you so much for being in my channel. So let's get into it. So, you know, a lot of you guys, are thinking still, and I've done so many videos, like I've probably done about 5 videos in the last month about whether we're in a boom, whether we're in a bubble, whether it's about to bust, what I think the next 3 years holds for the property market in Australia, the exact prediction of capital growth in Australia market wide. I've talked about hotspots, so go back to those videos for that kind of information. But in this one, I know so many of you are thinking about, the market is so hot, surely it's going to correct, surely it is going to slow down. At what point is it the tipping point after which prices start coming down or start cooling? All right, so instead of sharing with you my opinions, which really don't matter at all, I'll just be sharing some data so you can make up your own mind. All right, so here are the 5 things. So the first thing that I want to talk about is actually call this point number 0. So we're not on to the first thing yet. The first thing I want to talk about is the property clock. Now, so many of you guys subscribe to this theory of the property clock. And for those of you who don't know, it just means that every market, every suburb, every local government area, every statistical level 3 geography, has its ups in terms of price growth, and then its downs in terms of price growth. And there are so many pundits or experts in the property market, you and me included, that have their opinions on this. And there are even very well-respected valuation firms like Heron Todd White, for example. This is not a plug for them, but go check out their property clock. They've been updating it or maintaining it for, I think, more than 10 years. And every month they predict, which suburb, which market is at 12 o'clock, which means it's about to come down, which is at 3 o'clock, which means it's about to go down more, which is at 6 o'clock, which means it's starting to recover, which is at 9 o'clock, which means it's, already recovered, it's going through the next cycle of its boom before it gets to 12 o'clock. And if you look right now, basically what they are saying is that every single market in Australia is going to increase. All right, except for Wodonga in Victoria, except for Albury, except for Bathurst, except for Burnie, except for Canberra, I'm reading here, except for Dubbo, except for Launceston, and except for Tamworth. They think that those 8 suburbs or areas that I just called out are going to start declining, and the rest of Australia is going to continue increasing. But the thing with property clocks, and I've done many videos on this before, the thing with property clocks is you can't just take one property clock and just kind of make your decisions based on that. Why? Is because if you audit these pundits, if you audit or do a little bit of quality assurance on these property clocks, then you'll start to find that over the years, some of the suburbs, they actually travel counterclockwise on these property clocks. What do I mean by that? So if you take Heron Todd White, and once again, with all due respect, if you look at Heron Todd White's property predictions as per their property clock, you sometimes have, actually most times, have areas or suburbs or cities that they say in 1 month are at 9 o'clock, which means they're going to go up even further. And then 6 months down the line, it ends up at 3 o'clock, which means it's going to decrease. And then 2 months in the future ends up at 12 o'clock, which means it's gone backwards or anti-clockwise. I've audited all these sort of experts over the last 10 or so years in which I've been involved in property, and you actually start to find that these property clock predictions are completely useless. It's incredibly hard to do that. So this isn't even number one thing I'm saying. Number zero thing is right now a lot of property experts are saying that basically every market is going to continue to rise. That may or may not be true, but the thing that I want you to take away is don't just go off a property clock. They are notoriously inaccurate. Okay, so let's get into the 5 things that will help you understand whether the property market is about to peak or not. So the first thing is buyer fatigue. All right, so I'm looking at my notes a little bit here. So what you're starting to find, and if you're in the trenches like I am, you'll hear lots of conversations from frustrated buyers. Frustrated buyers, they're just really over this market. Tell me if this is you as well. Leave a yes below. If you're kind of really fatigued, keep missing out on properties, you're really frustrated by this market, like you're missing out on auctions, the prices are always going above what you think they would go at, what the agent said that they would go at. The price guide is, completely bogus. It's just ridiculous. Some people are charging on and, persisting and persevering. And a lot of other people are saying, look, this is just way too hard. Like they're throwing up their hands and they're saying, look, even if the property market continues to go up, I can't do this. You know what I mean? I can't keep doing this every Saturday at inspections. So that's the first thing. Sorry, that's not really technically speaking a data point, but as well as I do that more and more people now are becoming frustrated and they're just not even trying to buy properties, right? It's like the unemployment rate. The unemployment rate only captures those people who are actively looking for work. When people look for work for 3 months, for 6 months, for 9 months, and they get dejected after rejected, they lose interest and they just kind of put up their hands and say, I'm not looking for work anymore, right? So this is what's happening in the property market as well. And that's one sign that demand may start to shift away. The second thing is increased listings. And remember, supply and demand is the only thing, or are the only things that drive property prices either up or either down. When demand is higher than supply, naturally prices go up and vice versa. So right now we're seeing supply starting to increase a little bit. Demand is still there, don't get me wrong. Just because there's some fatigue doesn't mean demand is falling off a cliff, but there is some more supply coming on. And what I mean by that is that now vendors or sellers are more and more interested and inclined to actually sell their properties, right? So CoreLogic's report says that in the last 4 weeks, we saw an additional 27,000 new advertised capital city properties added to the market. All right. And this was the largest number since 2016. All right. And 17% above the 5-year average. So what that means in layman's language is that a lot of people are now putting their properties on the market to sell. Of course, this is still it's still something to be considered, but that means the supply is increasing. Now, when supply increases, even if demand is really strong, price growth tapers out a little bit. Okay, and Perth is a really good example of this as well, where a lot of stock on market is coming on because there are frustrated investors who bought there maybe 2 years ago, 5 years ago, 7 years ago. They haven't achieved the gains that they wanted. And so then now they're thinking, look, I don't know if this heat will continue. I'm going to capitalize on it while I can. I'm going to sell my property for a good price while the market is still hot. So that is bringing listings onto the market. But remember, it's not doom and gloom. Like total advertised stock, even though the percentage is increasing, like I just mentioned, the total advertised stock, in other words, new listings plus relistings, it remains still very low. All right. So even though the percentage is going up, they're growing, listings are more and more. On an absolute perspective, they're still incredibly low. In fact, they are tracking at negative 18% below the 5-year average. All right, so there's still record low listings. It's just increasing, that's all. Third data point, auction clearance rates. So like auction clearance rates have marginally been lower over the last sort of 4 to 6 weeks. from like a high of, let's say, 85% or let's say 84, 85, 86% in and around March or April. Now they're heading more towards the 70 to 75 in sort of May and June now that we're in. So, auction clearance rates aren't like a perfect predictor of property prices. You can have auction clearance rates of 50% and prices will still go up. You can have auction clearance rates of really high, like 100%, and prices may still come down. It's because auctions aren't the only way houses are sold, and the statistical reliability of relying on one metric isn't enough, really. But on aggregate, what we can see by average auction clearance rates sort of just softening out a little bit, just dampening a little bit, is just indicating that immediate buyer demand is not decreasing, but the growth is easing off. All right. There's a correlation between the two. So that's number 3. Number 4 data factor is building approvals. Once again, I think people spend, maybe this is you, I don't know, people spend way too much thinking about demand, what a property price is going to do, what is the demand story saying. Not enough people pay attention to supply. All right. Even like Brisbane, second highest population growth over the last 10 years, total house price growth of literally under 20%. This was kind of before the last few months, under 20%. So people think about demand side, population growth, not considering the supply side. Brisbane had the highest supply come online in housing and attached housing anywhere in Australia, basically. All right, so that's the reason prices haven't grown. I know that's disappointed so many of you and so many buyers agents and the like that don't know the data. But number 4, building approvals. So during the pandemic year, so let's call it 2020, building approvals actually dropped off dramatically. Like, lockdowns, hardly anything was getting built. But now approvals for new dwelling constructions are actually record highs. All right, so new dwelling commencements, I'm just reading here, over the December quarter and the last quarter as well, were almost 20% higher than the year before. Okay, and 6% higher than the overall decade average. So if you're saying, it's not hard for building approvals to be 20% higher than, the comparable quarter last year because we were in lockdown last year, fine, point taken. But they're also 5 or 6% above the decade average. All right, and we know just how high building approvals got in the last boom that ended 2020. 2016, 2017. All right, so this surge in new building activity, which has obviously been impelled by government grants and all that kind of thing, that is skewed more towards houses than units. Don't buy a unit, by the way, in most instances. I've done another video on that. Go check it out. But it's skewed more towards houses. And what that tells us is that with more and more supply coming on, especially like if you've bought in fringe areas of a city, like let's say, I don't want to call it doom and gloom, but let's say if in Sydney you've bought in Box Hill, or if you've bought in places like Rouse Hill or Richmond, or, kind of fringe even on the south side. In Brisbane, notoriously bad places like Pimpama, Mayo, notoriously, buyer's agent or property investment company, those house and land packages style, Mango Hill, North Lakes, Ripley, Springfield Lakes, all these areas are going to become more and more under pressure from higher and higher supply. Prices are unlikely to grow very much or continue growing as they have been. Okay, so that's number 4. And number 5 is that price rises, actually just median price value rises, are slowing. All right, so the rate of house price increase over the last little while has been dramatic. You know that, like since the last 5 or 6 months, it's been pretty crazy. But Domain just released I think it was their March quarterly data, which showed that yes, Sydney prices soared by more than 100K to a record of 1.3 million for a house and $751,000 for an apartment. Melbourne prices soared by $45,000. We're just talking in one quarter here, right? March quarter. $45,000 for houses and apartments grew also. In fact, let me just go through a table that I have right here in front of me. So year on year, at the end of March, Sydney grew by 12.6%, Melbourne 7.3%. This is houses, right? Brisbane 6.2%, Adelaide 10.4%. Who said you needed to buy only in Sydney? Canberra 19.5%, Perth 9.2%, Hobart 15.9%, still busting out. Darwin 8.4%, and the overall national, like for the mathematicians out there, you can do the weighted average real quick. Nationally, house prices rose by 10% in the one year on year. This is at the end of March 2021 compared to at the end of March 2020. Okay, my prediction, if you saw in a previous video, is that prices will go up by more than 20% this year. But despite this huge surge, the 5 things that I just talked through and what we're seeing in the actual median value data right now is that the price increase, that linear or that exponential, you could say, increase is starting to soften out. And so here's the thing. If you're asking me, well, PK, what do all these 5 things mean for whether we're peaking or not peaking? What is peaking is the momentum or the growth of house prices. What is not peaking is whether house prices will grow or fall. Okay, there's an important disconnect. One's a derivative, okay? It's commenting on the growth, and the other factor is commenting on whether it will grow or not. So what my point in this video is that for the rest of the year, the rate of growth will slow down. We're not going to see another $130,000 or $150,000 increase in Sydney house prices every 3 months like we experienced from January to March. What we will see is all those areas that have been growing continue to grow, but the growth will be more at sustainable levels. Okay, this is what we're seeing in the data. I shared 5 data points, or you could say factors, with you today. There are many others that we look in the background that I, marinate my mind through to be able to produce these videos. But basically, the takeaway from this video is, please, 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 if you think the house prices are peaking and that we're at the cliff and now we're going to tip over the other side of that mountain peak and prices are coming down, you have another thing coming. What is actually going to happen is that the climb, if we're mountain climbers, the gradient, instead of it being this steep, it will be this steep. Okay, so it still makes sense to invest or buy your principal place of residence or whatever you want to do. Prices aren't going to come crumbling down or anything like that. It's just the rate of growth will taper out. And here's the thing, I want you to just ask yourself, if you've been looking to buy your principal place, or if you've been looking to buy an investment property or your next one, what do I need to do in June, July? All right, June, July, we're almost finished June. What do I need to do in June or July to make that aspiration successful? To make that aspiration successful. You might have been fatigued, you might have been looking for months, you've been unsuccessful, you've been researching, it's overwhelming, don't know what to do, don't want to make a mistake, want to use data but don't know how to, don't trust other people. What do you need to do in June or July to make that aspiration of first home ownership or buying your first or next investment property successful? Too many of you, it's like when you have this big goal that I want to become financially independent in 10 years or 20 years. I want to have my time back. I don't want to trade time for money. I want either my wife or my husband to be able to cut down their hours. We want to fund our lifestyle, just do things that we want to do. When you have this long-term goal, it's very good, but it's also very intimidating. You don't really know what you should be doing. It's like it's too much to bite off in one go. What you need to do is break off that long-term goal. Instead of it being a dream, you need to make it into a plan. Okay, and a plan means, what am I going to do next year? What am I going to do the following year? What am I going to do the following year to achieve that? And reverse engineer, right? Reverse engineer a plan. But ultimately, that plan needs to come down to, what am I going to do in this first year? And then what am I going to do in the next 2 months? What am I going to do in the next month? What am I going to do this month? And what am I going to do today to make that dream a reality? Okay, too many of you have this kind of aspiration of, I want to become financially independent, I hate my job, or even if I like my job, I can't do it forever. But you're so fatigued on missing out on properties, you're so fatigued on watching videos like this and other videos that you just don't know what to do. You're overwhelmed, you don't know who to trust. It's like you don't want to make a mistake. Please, please, please ask yourself, what do I need to do, not in 10 years' time, what do I need to do this month to make that a reality? What do I need to do this week? What do I need to do today? Okay, and if you don't ask yourself that, then really you don't really have much chance of achieving that long-term goal that you have for yourself. All right, so hopefully this video really helped you guys. If it did, then please share it, tag someone who's going to benefit, hit subscribe on YouTube, hit the thumbs up button. The more of you that do that, the more of this video goes out to other people. And please try to do this yourself first. But if you can't do it yourself, if you can't successfully invest in property or buy your principal place yourself, then I'll leave a link below to the Property Investment Accelerator. I always say, guys, this is not a cheap course. Try to do things yourself first. But if you want help using data without using a buyer's agent, then click below and book a call with me, but only if you're serious. All right, guys, my name's PK, and I wish you all the very best.